Hi, hello everyone. Hope everyone is well. So today we will discuss about the difference between standard and itemized deduction. So suppose every person has a standard deduction amount in every year, and if you are a single person in 2025, your total standard deduction amount is $15,750. Basically it increases in each year, and because the personal expenditure amount increases in each year, so the government increases the standard deduction amount in every year. And what is the itemized deduction? If you have a lot of expense in different fields, suppose you have some mortgage expense, if you have interest expense, if you have car loan interest expense, and if you have something like that, uh, you purchased a car and you paid sales tax, and if you have other sales tax, and including everything, the total itemized deduction is over the total standard deduction. In that case, you can use the itemized deduction to calculate your total taxable amount. Okay, now we have a problem on here. This is basically that what amount we can deduct as the interest expense deduction on schedule A. Okay, so let's solve this problem. Myler, age 38, is a single taxpayer with adjusted gross income for the year of 167,000. During this year, Myler made the interest payments shown in the following table. In column C of the table, enter the amounts that are reportable interest expense deduction subject to a statutory percentage limitation, if any. If none of a particular payment is a reportable interest expense deduction, enter a 0 for that item in Schedule C. The total amount deductible on a Schedule A itemized deduction as interest expense will automatically calculate. Okay, now we have to decide that whether this amount is reported as a interest expense on a Schedule A. So if the amount is reported as interest expense in a Schedule A, then we can calculate it as an itemized deduction. So let's do the math. Mortgage interest paid on a $420,000 30-year mortgage loan used to acquire a principal residence. So principal residence mortgage interest is an eligible item, so we can take the full amount $11,400 as an interest expense for mortgage, and it is deductible. It is deductible on your regular income tax return. So 11,400 we got accepted. Points on a 30-year mortgage for the purchase of principal residence paid on June 30 of the current year. So this is not any type of expense. So points mean that when you pay mortgage interest in anywhere interest, the bank or the credit union may give you some points or any other amount, but that is not deductible on a Schedule A. So this amount is 0. Okay. Mortgage interest paid on 300,000 loan to purchase commercial rental property. Okay, and if we need to purchase a commercial rental property, and if we paid interest, that is totally deductible on a Schedule A. Okay, so it is 2150. Interest paid on personal credit card. So if you need to pay any interest on your personal credit card, that is not deductible, so it is 0. Interest paid to IRS for late filing of income tax return. So IRS penalty is not deductible amount, so we can put it as 0 because it is a penalty, and any type of penalty, interest on any type of penalty is not deductible amount on a Schedule A. Interest paid on a 50,000 home mortgage equity loan. Of the 50,000 loan proceeds, 40,000 was used to make substantial improvement to the principal residence. The other 10,000 was used to pay off the credit card debt. So that $10,000 is actually for a credit card loan. It is for your own personal things. Though interest on home equity is also your personal, but any type of interest that is related to your credit card, that is not deductible. So what we can do, if we need to calculate everything, so 40,000 is the total eligible amount. 40,000 divided by 50,000, it is 80%, and 80% multiplied by 750, it is a total 600. So total 600 is the total eligible interest expense amount. Okay. And the last item is that on row 12 below, indicate the dollar amount of the limitation if that any apply to the expense above. Enter any limitation as a negative number. So interest expense does not have any limitation on a Schedule A, so as much as interest you have, you can deduct it. So we can put it on a 0 on here. So if we hit on 0, so, and if we hit on submit, okay, there is 2 error. So what we can do, points, actually points means that if you save any points on your card, and if you pay mortgage interest for purchasing your principal residence, that is actually totally deductible. So it should be 4,200. And mortgage interest paid on personal commercial rental property, it is basically reported on a Schedule E. So it is deductible, but it is reported on a Schedule E, and in your Schedule E you should have a business rental property income and expenditure. Okay, so that looks good. We hit on submit. Now everything is correct. So mortgage interest 11,400 points, it is also deductible. Mortgage interest on commercial loan to purchase commercial rental property, it is not deductible. It is deductible on only a Schedule E, not on a Schedule A. And if you have rental income, then it can be deductible. And interest paid on personal credit card is not deductible. Interest paid on IRS late filing penalty is not also deductible. And this is partially deductible because some of the interest paid on credit card, that is actually not deductible. And AGI limitation, there is no AGI limitation, so it should be 0. AGI means adjusted gross income. Okay guys, thank you for watching my videos. Hope you understand between standard and itemized deduction. See you in the next video. Bye.